Hello and welcome, traders. Happy Monday as we're seeing a little bit of a rebound off of the open here in the market. Getting off to a great start to the week. Another exciting week for trading. I can't wait to get to it all. Big jobs report coming at the end of the week, but I'm sure we're going to see lots of surprises before then. Brian, how was your weekend? And congrats on the graduation for your oldest, Zach.
Yeah, that was great. Seeing your son, your own son, graduate from high school and everything they accomplished during the time is, something to be proud of as a parent. So I'm excited about that. It was a fun weekend of celebrations, and just ready to get back into it as these markets, trying to digest all the different news we've seen over the last few days between China tariffs on, off. We're upset. They're not agreeing. They're agreeing. It's the usual back and forth, right, Joe?
Yeah, it's kind of been a phenomenon we've seen in the past few weeks. Like when things are a little bit seem really good, something happens, and a wrench gets thrown into the machinery, and things get blocked up, and things start to seem bad. And then maybe a week later, things seems really, really bad, and a tweet comes out, and it's good news all over again. So it's just something we need to remember here for the next few months. It's never as good as it seems. It's never as bad as it seems. Just kind of let the market come to you. And we got some ideas about that, some trades for that as we go on. Again, thanks everyone for joining in. Just kind of be a little bit more a bigger picture, a little more zen, kind of, if you will, about markets and trading in this environment. Yeah, let me see if we can. I don't know. If we can get our screens in there, let's get the show rolling. As we're talking about, it seems like we're back on the trade wars. We had steel going back on to higher tariffs over the weekend. Of course, the Chinese trade wars on and off again. China is saying we're violating it. We're saying China's violating it. It definitely seems like the Cold War, if you want to call it that, with China and the U.S. is really kind of developing now. And it's really kind of in like this crucial spot now. It seems like the immediate future, we're thinking about these chips, these AI technologies. We have the technology to make these chips. We have the best software. We have the best engineers working on these chips in America. China has the goods. They got these heavy metals, these rare earth metals that are all coming from China. So it's we have one part of the puzzle. They have another part of the puzzle. It seems like we're limiting these chips to them, but they're saying, okay, then you can't have the heavy metals to make them.
Yeah, it's like, okay, I'm from Chicago, right? So it would be like, the Cubs and the Cardinals trying to make a trade, or the Bears and the Packers trying to make a trade with each other. It's like
In the
you're
same
going to
division, that
trade
doesn't
with
work.
your rival. You're going to try and make a trade with your rival. You're going to be very reluctant to actually follow through with that, right? I mean,
Yeah.
drill down as far as my little town Deerfield here against the town over Highland Park as a rival. Like I wouldn't want to trade one of my players over there and vice versa the other way. So it's like um, it's going to be difficult for them to come to some sort of agreement on everything. I don't think it was as simple as like, oh, now we're going to tariff them 30% and they're going to do us 10% and we're all going to be, we're all going to figure it out. It's going to really take some serious compromising on both parts, that both sides feel comfortable that they're actually working together rather than rival against each other, is my feeling. And I don't know if we ever get there.
Yeah, and if you go back throughout the past 30 years, as we've seen China rise from, um, essentially a third world country, but not necessarily quite a third world country, to now like the second largest economy in the world, on pace to become the largest economy in the world. When we started trading with China, we kind of looked the other way when they would say, "Hey, we need to take this IP when you come in here." Now, at this stage in development, at this stage in where the technology is, it seems really dangerous to just let them have these NVIDIA chips, these highest level chips that they could just copy and figure out how to do on their own. Also with the ASML machines that make the machines. So that's actually kind of like a third piece to this. It's like you got China, US, you got US, Europe, and you got Europe, China. We kind of need to keep the Netherlands where ASML is and Europe broadly on our side on here. So that's but at the same time, we need to get level trading field with Europe too. I think that's kind of the challenge right now for this trade war is we got to be on a team with Europe where we can work together a little bit better to keep them from trading this ASML stuff with China, because that's kind of a key component to the AI race. It's really important. We'll see. I get the feeling mostly because of Europe's proximity to Russia and Russia's alliance with China. I think they're going to be on our team by default, but just really important to keep that tech piece out of China.
Yeah, well, I mean, as you can see, it's a pretty complicated situation, right? I mean, you have major players with major economies, trillions of dollars of money flowing all over the world, and it's not going to happen as quickly as maybe Trump makes it to seem. Yeah, there'll be some compromises that maybe quickly come to the table, but there's not one quick magic bullet that's going to all of a sudden everybody's in alignment on how trade should look. There's going to be a lot of back and forth. It's probably going to take a few years for this to develop, and we shall see if even Trump is around after that, if his term comes to an end, before they can kind of figure out what goes where and how much. So there's really a lot riding on the table. Again, this is not a quick fix, but there are going to be lots of headlines that create volatility in the marketplace, and that's all we really care about, Joe. Right? We're volatility traders. We also like owning stocks for our clients, but we own volatility as a asset class, and so probably prevalent here to talk about what the long bonds look like, because this is something that we have really kind of stayed away from, right, Joe?
Yeah, and it's continuing to have some trouble. We're going to be talking about bonds in a little bit too, just even on the short end of the curve. But it's very interesting to see trouble in the long end of the curve. This is really important. Our borrowing costs are rising in the U.S. We're up to 25% of the budget is just servicing the debt itself. We're continuing to add to that budget. So the higher these yields go, is just, harder and more expensive, and just kind of leads to more inflation in itself too, because we're going to have to somehow find a way to pay for all this. So this is something I think very important to the market. I'd love to see this trend stop and turn around, bring these yields lower. We'll see how that turns out.
Yeah. I mean, we did get cautious words from Jamie Dimon the other day about the bond market having some cracks in it. And, maybe he's talking up his own book, because JP Morgan's very conservative. They're a money center bank. So when you do see distress in the bond market, JP Morgan's usually there to sort of sweep in and take advantage of lower prices. But he was mentioning there are some cracks in the bond market, and I imagine that comes somewhere in the middle to back end of the curve if rates go the wrong way that people expect them to go.
Yeah. So, anyways, we're gonna have a roller coaster again this week. We're gonna have Jobs Friday. There's gonna be some peace talks all throughout the week. You got Ukraine, Russia. Things are heating up in a big way there. They're also meeting in Turkey, a delegation. So it almost seems like impossible that anything can happen because of how much more active that war seemingly has become. So maybe it's just talks for show, or maybe something could actually happen. It's something just to keep an eye out for. Iran, U.S., they're having talks with their nuclear program there. Hamas and Israel talks continue there. So there's just a lot of things going on around the world. It's really remarkable. Oil is as low as it is, Brian. Maybe I want to get into that a little bit later too. I think oil has been one of the big bright sides for this economy.
Yeah, it's definitely been a deflationary effect, especially when you look at some of the PPI and CPI numbers in some of the costs of fuel and oil inputs that go into calculating all of the inflation metrics. And so that's been a deflationary effect that seems to at least giving rise to the Fed being able to cut rates, right? If we can get to that 2% inflation target that they always talk about, can they actually make a rate cut coming up here at the end of the year?
Yeah, and finally, I think I should have put on here, there could be a surprise news. Senate doing something with the budget. They're back off of their little mini break there. Are they? I don't know if they're going to pass straight up past the House bill. It seems unlikely, but if they get something done, I think the market might move off of that. If there's maybe more likely to get done, I think the market just wants to see whatever's going to happen so they can get out there and trade on it and kind of know on it. I think there's push and pull about how big the spending is going to be, how big the tax cuts are going to be. But I think the big thing the market, other thing is looking for is just some deregulation. And that could be really good for certain sectors specifically, maybe even the banks. Maybe that's what we need to see the long-term yields finally get a handle on itself.
Yeah, so let's talk about what we know best, which is volatility. This is the trading zone. We love giving trades. We do have a trade at the end of the show. Make sure you check out equityarmorinvestments.com if you want to subscribe to seeing those trades. We push those out Monday morning and then continue to update those throughout the trading week as we see opportunity to take them on and off, or we see a new trade that we want to put on before we jump on the show again. So go check us out there. But our really specialty is volatility. And when we talk about volatility, we love looking at what options are doing on the S&P 500 as one of the major indices. How are the downside puts behaving relative to an upside call of equal distance from where the market is trading at right now? And this is signaled by the skew. The higher the skew, the more puts are favored in premium. And we can see that skew has come way off the highs from April, but sort of holding in at this like 5 level, right, Joe? It seems like they don't want to push it lower, and people aren't that excited about an upside call just yet.
Yeah, they're not that excited about maybe either direction, kind of. It seems like maybe there's some momentum to have a consolidation here. Trade on the rally, sell a call, on the sell-off, sell a put might be something that we're seeing here. People are kind of thinking we're going to sit still, which goes with the sell in May and go away trade, which might be exactly where we're at. I think.
By the way, the sell in May and go away is sell volatility and go away, right? So
right, exactly. Sell vol in May and go away, and you can kind of trade it back and forth by selling a put when the market's down instead of buying the dip. You buy it by selling a put, and selling the rip is you sell it by selling a call. I think could be what this skew is telling us right here.
Yeah, I think that's right. I think there's some back and forth action. It's a great call. No pun intended there, but yeah, sell a call on the rip, sell a put on the dip, and that's a little hint. We might have that kind of trade for you here at the end of the show as we talk about NVIDIA. But
yeah, I think I would watch this if we got back above 7.5 here. Make a new relative high here. Maybe take note of that and see if that's going to lead to more volatility to the downside. If not, if you see this climbing up here, I think that's the time to be looking at the S&P 500 for a put to sell.
Yeah. And then when we look at like the VIX futures curve, and we take a look at that, here you can obviously see volatility's obviously, come off from where it was, let's call it back in March, April. The skew trying to get a little bit more normal here. I would say though that when I'm looking at the skew index, which is having a hard time of going further down, I also see the VIX having a tough time getting below, let's call it 18 or 17. And to me, that seems like an opportunity where I can own maybe some VIX futures if I see VIX get down to that level, because knowing that there's probably going to be some support and the decay rate may slow down, because you may get, even if it's an intermediary and just a 1 day or 2 day pop back above where I bought those VIX futures. So there's, to me, there seems like opportunity if the VIX gets too low. I don't know about right here, but I'd be watching, VIX below 20, then below 18 really is maybe an area where I want to own some VIX futures.
Yeah, I'm not sure about that. We got this contango happening. We got this little bit of a steepness happening from the front to second. I think this is what people who like to be short the VXXs and the ETNs of the world are looking for. So that's a little bit of opportunity for them. We'll see. You definitely can see some volatility in this front month if we do get a snapback, which the VIX has done that time and again, going from like 19 to 23 repeatedly. So you should expect some volatility in the front month. Very tradable. But outside of that, just kind of looking for the contango effect. I think that there is opportunity there.
Yeah, actually, I mean, that is a good point. The contango effect, I mean, that's what the short VXX traders look for, because there is that decay effect where the VIX future has to come down and settle into the VIX price. So they get that short effect to it. I would just say if the VIX falls too far, there might be some
we are
opportunity to end up
absolutely just the low end of the range for the VIX.
Yeah.
I hear you there. Big run up, of course, in the S&P 500. Saw just an incredible month of May. There's no question about it. But now we're just kind of in this no man's land. We didn't make an all-time high. It's just kind of still in doubt whether or not the high was in end of last year, earlier in the year, or if we're just kind of pausing here, consolidating for the summer.
Yeah, it was I think one of the best Mays ever on record, maybe in the last 20 years, in terms of the performance of the market in the month of May. So, obviously there was a lot to bounce off of, right? Everybody had so much fear about tariffs and the trade war and what that was going to happen in April. So there was room for it to run to the upside. This is why when we're trading the markets, we like owning volatility as an asset class, because now I can, we stayed invested in stocks. In fact, bought more when the market was lower and sold out of that harvest of volatility when volatility was higher. So
well, this is where it becomes really like important to understand like the dynamics. So because yes, in normal times, if people can understand, it's great to own volatility here and sell it here and then buy the market. But like, what do you do like in this period here? Like, how do you stay protected there? That's why it's really important to kind of have a deep understanding of the market. And I'm not sure if we're going to see more upside, if we're going to see another period like this for the next few months. I think both are possible. We're going to get into that in a little bit. But yeah, I think we're just kind of in a really tricky spot here waiting for the next move.
Yeah, it does seem like a tricky spot. Again, it's probably the right thing. Just sell strangles by selling puts on market a little lower.
Yeah, I mean,
calls when it's a little higher. And then
big picture here. I think it's great that we're above this level here, 5,800. It's very similar with the NASDAQ big picture, still above this 2,100 level here. I think maybe even further. This down here, this like 2,000. It's going to be above that. So just watching that. Just as we go, semiconductors. It's they were beaten down so badly to start the year. Everyone was really down on them. I thought we saw two amazing quarters from NVIDIA. Really, to be honest with you. Last quarter, they just got absolutely clobbered. They talked about how they can't sell. The China's market's basically closed off to them. This quarter, another fantastic quarter, and everyone thought like the cloud, the deep think, or the Chinese AI company is going to mean that we won't need as much computing. That all has been proven wrong. Google has said so as much. All these companies are still building out these data centers. The AI data center is still in the early innings, based off of NVIDIA's last earnings, which is just kind of like remarkable to me. Just want to look out just a little bit further. Sorry, a little bit further out here for the semiconductor, and just think about where we've come. Right, we had going back to pre-COVID, but we just had basically when we've gone from 50 to 250 in about 7 years, about 6 years, which is just a 5x return, 500% return in 7 years. You'd like to see 100% return in 7 years in stocks. I think you'd be lucky if you do get that. So we're in semiconductors. We're 5 times that here. And is there more to come? Well, just kind of looking at this consolidation period we've really seen it over the past year. Consolidation. I think there's potential here to come back alive.
Yeah, I think you look at this chart too, Joe. It kind of looked like sort of a double top, right? Where on that right side or the end side, it looked like it couldn't make a new high. It was getting stagnant, running out of steam. April flushed things out, and now the semis have rallied, and valuations just across the board across the semiconductor industry, not just Nvidia but others, really seem more compelling than they've ever been to me, given the amount of growth that could be there. And that reversal is kind of interesting. I think, another little bit of a leg up higher could be very bullish here. And that chart, Joe, looks very good to me.
Yeah, this is of course Nvidia shorter term. Let's take a little bit longer term. Nvidia, just fantastic earnings, obviously. Longer term chart of Nvidia with its PE. I mean, the PE can be very volatile, as we've seen, Brian. But of course, it can get up there. It can, it right here. People were not aware of how much the company was going to have earned. And they just outgrew their expectations time and time again. But we're now at an area we've seen, 50 to 60 kind of be the norm for NVIDIA's PE ratio. We're now at an area where we're down to 30. I mean, we did get this hit when their earnings expectations said, they're not actually going to be earning what we thought in China. But there's potential to make that up elsewhere around the world. We do have orders coming in from the Middle East, and there's a chance that they could get their way back into the Chinese market too. So bottom line is we've seen NVIDIA trading at a much higher PE throughout this time period when we've seen this tremendous growth. We're at a much lower PE right now, and go back in time, you see when NVIDIA does get to these low levels of PEs, maybe it takes a minute, but usually it's a pretty good opportunity.
Yeah, it really is. Like, just look at like when the PE gets into this like 30 range here, go back, look at each of those time frames. Sometimes, like you said, it takes a few months for it to work itself out, but it's typically been pretty good buy opportunity to own this stock. And obviously there's going to be competition down the road, call it 5 or 10 years, especially if supercomputers ever make their way to what they're expected to do, or other chips coming into play to compete with NVIDIA. But for now, they're the main player. They're the main game in town. And it's interesting how hard this thing has rallied off the lows, and then coming out with a good earnings report like it did. I would likely be a buyer of this. I just don't. I mean, I wouldn't have 100% of my portfolio in NVIDIA.
That's good. I think there's some uncertainty out there, Brian.
Yeah.
Let's come back. Hang with us. We're going to do a trade on NVIDIA in just a second, but I want to talk about something I'm noticing elsewhere in the market. So this is, people have seen gold going up over the past year and a half, but something that I think we should be looking at, and I don't want to be alarmist and say that this is, something eminently is about to happen, but something we should be looking at is we've seen a recent dramatic rise here in money market funds. Okay, so people are putting more and more money into cash right now. Now, this is kind of like credit card debt, okay, where you look at credit card debt over time, and some people will be very alarmist and say, it's the highest it's ever been. Well, the economy is also bigger than it's ever been. So it does make sense that there's more money in money market funds now than previously before. But if you just go back and look at previous instances where we saw a sharp rise in a short period of time, there is some things to worry about. So if you look at, of course, in 2019, into COVID, very sharp rise, into 2007, into 2008, a very sharp, very fast rise. And of course, the 2000 .com bubble, another rise. So this is a sign people are taking some money off the table. Instead of investing in risky assets like stocks or real estate or other investments, they're choosing to take the risk-free investment of the money market funds.
Yeah, I mean, some of it could be a function of interest rates during all those periods where interest rates were rising. COVID a little bit different because people were just freaked out in general about a pandemic. But the other two times before, rates were rising, so it kind of incentivized people to move and just take like you said, the risk-free rate, the money market fund rate instead. So that could just be a function of where interest rates are moving. And it could also be a sign that the Fed does need to cut rates, because if people are so incentivized to be in a money market fund instead of investing at some point, um, the Fed should be in favor of increasing productivity, increasing investment, and maybe it's about time that they start to cut rates. But in general, you're right. This is somewhat of a warning sign that not is all clear for this market.
Yeah, well, and it's also kind of like a self-fulfilling prophecy, and that's exactly right. So you had a hot economy. You can almost view it in like the leading indicators chart, which I have up here. You can see leading indicators, hot economy, that leads to inflation, of course. And then like they realize, oh, the Fed's probably going to raise the short-term rates. And of course, as soon as that happens, as soon as the Fed does raise their interest rates right here, you do see this leading indicator start to fall. So that is kind of exactly what the Fed's point of raising interest rates is, to make it so people have more of an incentive. There are two things happening: more of an incentive to save because the interest rates they're earning is more, and less of incentive to borrow because it's more expensive to do so. So it's absolutely something that happens. But now we're kind of at a point where people are looking at these like high short-term rates and thinking, oh, I might as well just save. And it's kind of becomes like, even though the economy is strong or still strong right now, it kind of becomes a self-fulfilling prophecy. The more and more people are saving, the less they're spending, the less companies are putting into research and development, the less people are getting hired in new jobs. So it's just a drain overall on the economy. And historically, when you see this, of course, this drain ultimately has led to a recession. Now, I talked about like why isn't this happening so far this time around? I think at the same time, we've got a huge benefit of oil coming from a high level, coming down over this time period. So that's been a big boost to the economy. And the other thing, of course, is in spite of the fact we don't have a budget yet, we're still running record deficits as a government spending. So there's still, even with Doge, I know we're still spending record amounts of government money here. I think this is all still kind of propping up the economy. We have seen the unemployment rate rise very modestly. But we have not really seen any sign of a serious economic slowdown.
All right. So given this, obviously there is some wall of worry here, right, Joe? There is some concern. I think this is why the VIX. I mean, yes, there's lots of news, and the market's reacting to that news and moving a lot faster, and so volatility, premium of options are a little bit higher in general. But I do think the VIX is also at an elevated level. I talked about this last week, that the VIX being elevated could be some of these concerns about either recession or pullback in the market, or people, sort of getting out of the market, being in money market funds. All these are sort of adding up to, recessionary kind of like numbers and concerns. And so I think this is why the VIX has been trading higher than normal. So, we'll see how this plays out. But I think everybody's wanting to know what do we do with Nvidia, which has been a leader in this market, which is sort of pushed the market one way or the other, almost one could say. What do you do here, Joe?
Yeah, so we were really into Nvidia. We've been into Nvidia. I think the AI in this tech cycle has really saved this market. We have not seen anything out of the small caps over the past few years, Brian. The small caps have done nothing, but the mega caps and the big tech companies have been saving us. And for me, it's really exciting. And for me, I am a firm believer still. The AI is going to increase productivity. There are things that I don't even know are coming, which are going to be world changing still in this AI world. So I'm all in on Nvidia. Now that doesn't necessarily mean I need to go out and buy all these calls or put all my money in Nvidia right now. We talked about at the start of the show. We're kind of in this wait and see consolidating mode. When the market comes down, we want to sell a put. When the market goes up, we were looking at selling a call. Well, Nvidia hit 143, Brian, right after earnings. And now we're back down to 136 and some change in Nvidia. So I think if we fell back to 130, I'd love to get back into it. Absolutely no question about it. So I would love to sell the June 130 put just to have a little bit of insurance on it, although I don't necessarily need it for me. I'd love to just own at 130 either way, but just to make sure in case something crazy happens, buy that 120 put. I get to collect $1.50 here. Basically, I'm looking at about 2.5 weeks here to hold on to this. I can make 1% in the name just for sitting on my hands here and have a lot less risk on the table. Now, if we in this next cycle, if we do trade like 160, yeah, it'd be way better, of course, to own the stock here rather than this trade. But I think that's not what we're looking at in the very short term. The very short term, there's a lot to settle here. At some point, things will settle. We're going to get another opportunity to buy it, just have a little more hard deltas long. I think the best trade is just take these soft deltas, as they say, collect these premiums, sit on the sideline, and wait for this entry.
Yeah, this is about a 17-18% annualized return here by selling this premium, right? So I'm going to set cash aside to own the stock. One put is equal to 100 shares. So I would have to have $13,000 set aside to own the stock at 130. Now I have the extra put as protection, so you could use this trade to a leverage degree if you wanted to. But if you wanted to do sort of like a cash covered, that's what you would expect. So if I'm outlaying 13,000 and I get to make,
but by the way, that 120 puts about 50 cents. So it's a lot better if you decide to do it fully cash covered, of course. Yeah.
Right. But yeah, this is a trade where annualized, this is a 3-week trade, right? This is less than 3 weeks now at this point. The third Friday of June is when this will expire. So we gave a lot of macro picture of like maybe a longer term view on the economy and a longer term view on NVIDIA. This is just the short term where we're trying to find the best of breed in the market, collect some premium here, and to the point of our back and forth action of sell vol in May and go away. This would be one of those trades that I like doing.
Yeah, absolutely. I'd love to get put to the stock here at 130, buy it at 130. I think the 50-day moving average is right about at 130. So you'd love to own it at 130. Then you see it rally back to 140, buy right it, sell the call against it. It's exactly rinse and repeat in this environment. That's what we're looking to do.
All right. Well, I think that's about it for us here, Joe, on the show. Every week here on Trader Hub, put on by them. Thank you very much. Equity Armor comes on here. We not only give our trade of the week, but we digest the markets. We talk about what our specialty is, volatility trading, which is what all our strategies tend to have some incorporation of that, as we believe that's an asset class that people have to own with the rest of their portfolio. So make sure you go and check out equityarmorinvestments.com for all of our latest strategies, our trades. Subscribe to our Trading Zone weekly subscription of trade ideas. Love to have you, and feel free to comment even during the show if you've got some objections or some questions. But if you tune in every Monday here, 10 a.m. Eastern, we're bringing my colleague Joe Teague's brightest and best ideas to you, along with mine. Make sure you tune in every Monday. We'll catch you next week.
Have a good one.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.